What if I told you that a single misunderstanding about what counts as income could cost you thousands of dollars? No, seriously. Imagine working hard all year, thinking you followed every rule, only to find out you owe the IRS more than you thought, just because you didn't know one important thing. It's not about how much you earn. It's about what the IRS sees as income. And that is where most people mess up. Let me show you what no one ever taught you in school. This is the full story of taxable income. Explained in simple terms. Stick around, because we're about to uncover the hidden traps that quietly drain your bank account. Number 1. What is taxable income really? Let's not sugarcoat it. The IRS wants a piece of your pie, and they'll take a slice from more than just your paycheck. Taxable income is the money the government uses to decide how much tax you owe. It's the total of everything you earned in a year, minus the stuff they allow you to subtract, which we'll get into later. Now here's the trick. Most people think only their job income counts, but that's just the start. You could be taxed on money you didn't even realize was income. Did you get a bonus? That's taxable. Sold something online? Taxable. Rented out your garage? Yep, also taxable. Even the cash your cousin gave you for helping with his wedding photos might count. If it brings you financial value and isn't on the IRS's tax-free list, it could add to your tax bill. Let's say you earn $50,000 from your job. You also made $6,000 driving for Uber on weekends, and you earned $1,200 from selling vintage sneakers online. The IRS doesn't care if that money came from your boss or your trunk. It adds up. Number 2. Earned income versus unearned income. What's the difference? Think of income in two buckets: earned and unearned. Earned income is what you bust your tail for: wages, salaries, tips, commissions, side hustle money, even that Etsy shop you started during quarantine. Now unearned income. That's money that shows up without you actively working for it. Dividends from stocks, interest from savings accounts, rental profits, even gambling wins. One's sweat. The other is more silent, but the IRS taxes both. Let's imagine you work at a coffee shop and earn $30,000 a year. You also have a little savings account that earned you $250 in interest, and your dad gifted you some stock shares that paid out $600 in dividends. That's $850 in unearned income, even though you didn't work for it. Taxable. Your tax return doesn't care whether you lifted a finger or not. Number 3. The surprising stuff the IRS considers income. Here's where it gets wild. Some things sound harmless, even generous, but they count as taxable income, like winning a contest. Let's say you enter a radio giveaway and score a $1,000 gift card. Guess what? You just won taxable income. Or maybe your boss gives you a $300 prepaid Visa card during the holidays. That's nice, but also taxable. Got student loans forgiven. Unless it's a government forgiveness program, that could be considered income too. Even bartering is not off the hook. Let's say you fix someone's broken laptop and they pay you with a pair of concert tickets worth $200. The IRS wants to know. It's not about cash changing hands. It's about value. If you gain, you might owe. Number 4. What's actually not taxable? Let's breathe a little. Some income is tax-free. Gifts? If someone gives you money out of kindness, not for services, you're good. Your grandma gives you $500 for graduation, that's all yours. Life insurance payouts? Also not taxable. You're not taxed on the payout if someone close to you passes and you're the beneficiary. Child support? Not taxable. Even welfare and public assistance like SNAP benefits, safe, and scholarships, as long as they pay for tuition, fees, or books, they're tax-free. But if the scholarship covers your meals or off-campus housing, that part can be taxable. So while there's some breathing room, there are also gray zones. Always check, because peace of mind beats an IRS letter. Number 5. Deductions make a big difference. Here's a little good news. Your gross income isn't what gets taxed. You get to reduce it. That's where deductions come in. They're like shields. They lower your taxable income, and that lowers your tax bill. The most common one? The standard deduction. In 2025, it's about $14,600 for single filers. So, if you earn $60,000, you automatically subtract $14,600. Now your taxable income becomes $45,400. That's a big difference. If you itemize, you might deduct more. Things like mortgage interest, State taxes or medical expenses could also lower your tax burden. Deductions don't give you money, but they keep some in your pocket. Number 6. Social Security benefits, taxable or not. This part shocks retirees. A lot of people think Social Security is tax-free. It's not always. If Social Security is your only source of income, it might not be taxed. But if you have other income, like a part-time job or retirement withdrawals, then part of your Social Security could be taxed. Here's a simple example. You get $20,000 in Social Security and another $30,000 from your IRA. Now your total income hits a threshold where the IRS starts taxing up to 85% of your Social Security benefits. The math gets messy, but the bottom line, retirement doesn't always mean tax-free. Plan smart. Number 7. Side hustles can bite you. Side hustles are hot, but so are the IRS's eyes on them. If you earn more than $400 a year from self-employment, you must report it. And yes, you'll owe both income tax and self-employment tax. Let's say you sell homemade candles and make $2,000. Even if it's part-time, it's business income. That means you might need to file Schedule C. You'll also owe self-employment tax, about 15.3%. So $2,000. You might pay over $300 in taxes. And if you get paid through Venmo, PayPal, or apps, they might send you a 1099 form, and the IRS gets one too. Keep good records, because tax season isn't the time for surprises. Number 8. Investment income, where quiet money gets loud. Stocks, bonds, real estate. All great ways to grow your money. But they also come with tax baggage. You earn interest in a savings account. That's taxable. Sell a stock for a gain? Taxable. Let's say you buy shares for $1,000 and sell for $1,400. That $400 gain is income. If you held the stock for over a year, you'll pay long-term capital gains tax, often lower, but sell it too soon. Short-term gains are taxed like regular income. Even dividends from companies? Also taxable. Some are qualified and get lower rates. Others are ordinary and taxed higher. It's complicated, but worth learning, because investment income is where the wealthy get taxed the most or the least if they play it right. Number 9. Forget to report something? Here's what happens. Let's be honest. Most people don't lie to the IRS. They just forget things. But forgetting doesn't make the IRS kinder. Let's say you do some weekend photography gigs and earn $2,000. You forget to report it. Then the client sends a 1099 form to the IRS. Now the IRS knows you earned it. Even if you forgot, best case, you get a notice. Worst case, you get audited, and you'll owe taxes, interest, and possibly penalties. A $2,000 mistake could turn into a $2,600 headache. Track every stream of income, even the weird ones. It's not about fear. It's about peace of mind. Number 10. How to keep the IRS happy. Here's how to avoid chaos. Keep records. Use a spreadsheet or an app. Save your W-2s, 1099s, and bank statements. If you do gig work or get paid in cash, log it. Make a habit of checking your income monthly. Don't wait until April. Understand what's taxable and what's not. And when in doubt, ask a tax pro, because getting it wrong costs way more than asking for help. So here's what we've learned. Taxable income isn't just your job. It's bonuses, side gigs, rental money, investments, and more. It's money that moves, even if it doesn't hit your paycheck. And knowing what counts is half the battle. Because when tax time comes, what you don't know can hurt you. But now that you've seen the full picture, what's one thing you were most surprised to learn is taxable? Let me know in the comments.